Hi, everybody, and welcome back to video number 3. And when we left off, we were looking at the principles of accounting. And I think, again, this should be somewhat familiar to you from your basic financial accounting class. There are 4 basic principles, as I think you know. We have the measurement principle here. Oops. The measurement principle here, and we measure that at historical cost. But sometimes you're going to find that we measure that at fair value, a new concept. The revenue recognition principle says that we must recognize revenue when the performance obligation is satisfied. Normally, that's when, if you're a manufacturing company, you ship the goods out the door and the customer takes possession of those goods. The expense recognition principle requires that expenses that are used in generating those revenues are expensed in the period in which the revenue is recognized. In my example, we're going to have a debit to accounts receivable and a credit to sales. That'll be the sales side. But we're also going to have a debit to cost of goods sold and a credit to finished goods inventory. And then lastly, full disclosure principle. That says that we usually have notes to the financial statements and that it recognizes that we have included all the necessary information necessary to provide a fair financial statements that fairly depict the operations of the company. All right. So the fair value hierarchy here, we have some observable inputs that reflect quoted prices for identical assets and liabilities. So that's the least subjective. We can find out things like closing stock prices in the Wall Street Journal relatively easily, and they're accurate. Sometimes we don't have that, so we have to lean on something a little more subjective. Similar assets or liabilities in an active market. And then lastly, we have to maybe make some generations of our own assumptions in a more subjective way and to arrive at a relevant and representatively faithful fair value measurement. It's the most subjective. Okay, we have 5 steps in revenue recognition, and here they're illustrated. We identify a contract. I'll let you read these. These are pretty straightforward. Here we have Boeing, that's an airplane manufacturer. It's delivering some planes to Delta. Boeing has only one performance obligation, and that's to deliver those airplanes. And if Boeing also agreed to maintain the planes, a separate performance obligation is recorded for that kind of a thing. So we've determined how much it costs for, let's say, a 737 or a 747, and then let's say it's $100 million. That's a fairly small Boeing airplane. And in this case, the transaction price is straightforward. It's $100 million. So we're going to allocate the transaction price to its separate performance obligations. And lastly, when Boeing recognizes that $100 million, it satisfies that performance obligation when he actually delivers those planes to Delta. Okay, now product costs, I think you'll remember that from 1B or 102 as the case may be, and here managerial accounting, and here there's a direct relationship between cost and revenue. We recognize that in the period that the revenue is generated, in my last example, when the goods are shipped. But period costs here, period costs, we're going to recognize that in the period in which those expenses are incurred. So my salary, for example, as the CFO, would have been a period cost, whereas there may be some delay in recognizing revenue with all this labor, material, and overhead. It's not going to get recognized in cost of goods sold until that product is actually shipped. So here is an illustration and the why. We provide information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors. And we went through all these, so I won't go through that again. And the third level of implementation, recognition, measurement, and disclosure. All right. So now we want to put into practice a little bit by identifying the assumptions and principles. Here they all are for FASB. And then the instructions, we're supposed to match those. And here they are. You'll have to go back and check that out in your study of this. But I think you should pretty well have this down from our previous course. All right, now let's take a look at the major challenges in the financial reporting environment. Here, GAAP is as much a product of political action as it is of careful logic or empirical findings, as the situation with Enron illustrated. Okay, so let's take a look at that. The FASB is pushed in a lot of different directions. Here we have CPA firms, the AICPA, academicians, the investing public business entities, etc., etc. My illustration of slotting certainly illustrated that industry has a great deal to do with whether a FASB would be generated or not for a specific treatment of accounting. In my case, slotting of foods in the business. And so here, what are those challenges? There is an expectation gap here. That expectation gap is what the public thinks we should do compared to what we actually do. And it's difficult to close that expectation in light of the accounting scandals that happened mostly in the early 2000s. And then, as a result of Enron and WorldCom, Congress came down with the Sarbanes-Oxley Act, often called SOX. I was the SOX coordinator in my last position, and I would tell you that we did 100 audits every quarter on Sarbanes-Oxley, 100 that could not be done by our finance and accounting staffs. Had to be done by marketing and manufacturing. I had to train all those people to do it. And then I had to evaluate that as to whether we had any internal control weaknesses. And of course, if we identified any, fix it. And then those conclusions that I made and an audit of those audits by an outside company had to be done. In our case, it was Price Waterhouse that did that. And that whole system is overseen by the Public Company Accounting Oversight Board, the PCAOB. And so we have non-financial measurements. Financial reports don't provide some key performance, such as customer satisfaction index, backlog information, reject rates, et cetera, et cetera. Those are not provided on financial reports. And our financial reports don't do really much in the way of forward-looking information to present to these needed by present and potential investors and creditors. Yeah, and then our soft assets, know-how, brand images, intellectual property, those kind of often called intangible assets are really important and not necessarily found on those financial reports. We look at hard assets, but not our soft assets. And then timeliness. The companies only prepare financial statements, I should say publish the financial statements quarterly and provide audited statements annually. Almost all companies do it either monthly or close to monthly as well. So that's still no real-time financial statement information. And then our investors and market regulators are raising concern about the complexity and lack of understandability of financial reports. I think as you get through advanced accounting, and for that matter, this course in intermediate accounting, you'll realize how hard it would be for the layman to truly understand those reports. Okay, so ethical challenges frequently encounter ethical dilemmas. I have many stories along those lines, but we can ask me that at our tutoring sessions, and I'm happy to go through that, as well as slotting if you want to. But doing the right thing is not always easy. In my mind, it's almost always obvious, though, but it doesn't make it any easier. And GAAP does not always provide an answer, but it does provide some answers. Okay, so let's compare GAAP and the IFRS and their standard setting process. And here, the IFRS is like the GAAP. We're trying to do convergence to make one set of standards, but it's not there. Where it is yet. We still have those two sets of standards. So the IASB is also a private organization, and it is overseen by the International Oversight Securities Commission now. Now, both the ISB and the FASB have essentially the same governance structure. It's a foundation that provides oversight, a board, an advisory council, and an interpretations committee, and in addition, a general body that involves the public interest in part of the governance structure. We have some similarities. We work together. I mentioned convergence here. A good example is the new standards on revenue recognition that both organizations support. Whereas the ISB has completed its conceptual framework, FASB has not. The objective of financial reporting and the qualitative characteristics of useful information are the same between the two. But there are differences. GAAP is more detailed, rule-based. IFRS tends to be simpler and more flexible in the accounting and disclosure requirements. The difference in approach has resulted in a debate about the merits of the principles-based versus the rules-based standards. And then there's differences between GAAP and IFRS. It should not be surprising because the standards setters have developed standards in response to different user needs. In some countries, the primary users are private investors. In others, the primary users are tax authorities or central government planners. In the United States, investors and creditors have driven accounting information formulation. All right, another difference here. The IASB gives more emphasis to stewardship in its conceptual framework. And you can read more about this in the textbook, but it does indicate that the framework needs information about the resources, et cetera, stewardship, and the like. Explicitly discusses the need to provide information related to stewardship of resources. Okay, one last thing. The ISB has clarified a couple of other concepts. Here you can read about those on your own. And we're still trying to increase the use of fair value in reporting. And again, you can read about that on your own. And that concludes this video. So bye for now until we do check